Welcome back, everyone. It was so much fun at the beginning of the meeting that we're going to do another round of introductions and see if everyone gives us the same answers.
Oh, okay. My name is Brianna Howard. I'm a retirement specialist with the retirement division, and then I also process the disability retirement.
Dawn Netto, Chief Retirement Specialist, lead the team of our retirement specialists.
Hi, everyone. Krista Franks. I am the front office supervisor of the retirement division.
Bill Meckel, Secretary of the Board.
Emily Heyman, Citizen.
Hi, Rob Luciani. I'm a Vice President with Empower.
Gabe DeLeese with Empower.
John Potter, an employer representative on the board.
Gleason, also on the board.
Nicole Weidman, Director of Operations and Policy.
Tim Duggan, Director of Vermont Retirement Systems. Gavin Boyles, Deputy Treasurer, here for Treasurer PChat.
Jonathan Kowalik, Senior Consultant with RBK.
Sarah Buckthorpe, Consultant with RBK.
Justin St. James, General Counsel, Treasurer's Office.
Jeff Gilson, Growth Executive with Optum Financial, here to talk about the retiree health savings plan today. I think I might be last on the list today, so save that last.
Morgan Dale also on the board, and then we'll go into the team's room.
I'll go first. I'm Melissa Shimento, the Client Service Manager with Empower for the plan.
Ryan Marhafka, Client Service Manager, also with Empower, assisting on the plan.
I'm William Liberty. I'm the employee rep.
I'm Kristen Green. I'm the communications strategist with Empower.
I'm Joe Fine, investment director for Empower, supporting the plan from an investment perspective.
Tim, if I may, there'll be one more representative or potentially two joining us. It would be Gillis Owen, who's one of the retirement plan advisors here at Empower, and Brian Feisick, who's also a retirement plan advisor, and Chip Stanville is out on vacation. Thank you.
Well, sounds good. Well, we are now ready to turn it over to Empower. Unless you want to tee anything up, Tim.
No, really grateful actually to have a lineup of folks for the second half of our meeting to really focus in on our supplemental plan. So first up will be Empower to do their quarterly update. And then we have RVK, who we recently brought on board to help us oversee those plans. And last but not least, Jeff from Optum, we gave the overview last meeting of the MHRSP and wanted to drill down on that a little bit further and have you meet Jeff to put a little more flesh on the bones that we provided last week. So with that, I'll turn it over to Gabe.
Thank you very much, Tim. And good. It's wonderful to be here. It's been quite a few years. So wonderful to see many of you and meet many of you for the first time. Again, Gabe DeLeese. I'm the relationship manager for Empower. And we administer all of the retirement plans. Today, we're going to talk about the municipal plan. And with me is our executive in government, Rob Luciani, who also happens to be my boss. So whatever you want to say about me, please have at it. You've met the Empower team that's there now. So I'm going to ask Melissa if you can share the presentation, please.
Sure thing. And if everyone could just remain on mute.
What pages? Go ahead.
Sure. I was just going to say, if everyone could remain on mute, just in case there's any technical issues, please let me know if anything starts sputtering or if you need me to go back at all.
Thank you, Melissa. Okay, with respect to the, before I get into some general metrics regarding your program, I want to make sure we keep to our timeline here. I'm going to spend 10, 15 minutes on it. And then I'm going to ask Joe Fine to provide an investment review he'll show. But I just want to share observations, what we're seeing in the marketplace. Wow, volatility. It has been an incredible volatile quarter. And what we're seeing across our book of business, which I'm pleased to say, is that many participants are staying the course. We are getting phone calls, especially, the most nervous are the ones that just retired or thinking of retiring. But a lot of individuals are staying the course, but some are talking to us saying, just want to have a conversation. Am I doing okay? What should I do? Should I kind of just leave it? It's been a complete 180 in this business, where anytime there was, extreme volatility in the markets, people, quickly bailed out and sold their investments. They're not doing that. Participants are getting naturally smarter and they're staying the course. They understand this is retirement. So they're becoming more and more educated into the program. So that's just exciting to see that, recognizing that there is still a lot of volatility. Participants are still, paycheck to paycheck. A lot of them are still struggling financially, right? So we understand that. But with respect to your plan, I'm going to give you a snapshot of the VMERS retirement plan. And for the period ending March 31st, page 3, Melissa, ending March 31st, there was $30.716 million into the plan, as you can see, at $30,716,512, representing 423 participants. Now, again, that was March 31st. Just quick forward to April 5th, just the other day, Cinco de Mayo, it was at 31,282,000. So we're up about $500 million. You could see the volatility in the markets, on any given day. So next page, in terms of an executive summary, and I'm going to really look at not only the average account balance, but we're going to look at the investment strategy utilization, how people invest in their money. We're going to look at money coming in and money going out. That's pretty much it in a nutshell in terms of what participants are doing. But as you can see here on page 4, average account balance of just under $73,000, and the investment utilization is, and we'll break down these a little further here. My total retirement, which is professionally managed accounts, free online advice, target date strategies, asset allocation, which is goal maker, and that's combined with the target date strategy, risk-based strategy. Those are people in high funds, and then do it yourself. For this plan, for most plans, we see the do-it-yourself being the most popular, if you will, asset investment strategy. But for this plan, it's a target date strategy. So 57% plus another, 9 or so. So 60 some odd percent of participants are in some type of asset allocation strategy, which is really, really nice to see. And I'm just going to go forward here a little bit. Melissa, I'm going to go to page 8 real quickly. I want to look at cash coming in the door. So you can see a quarter over quarter demographics there for you. But generally speaking, what you see for the first quarter was $321 million $321,000 coming in contributions, almost $574,000 coming out with a net negative cash position of $252. And you can see the breakdown there. The lines I will point you to is the fourth quarter of last year and the first quarter of this year. When you look at that last line, change in value, that was market valuation. That is why you see the ending period of $30,700,000. When we look at contributions on the next page, again, year to date and a rolling 12 months. So for the first 3 months of 25, we had $161,000 in contributions come in on a before tax basis and an employer match in the situation representing. So $321,000 came in contribution. And then below is the rolling 12 months. And below, you can see the different breakdowns of the monthly activities. There was a spike, obviously, in August of 24, but you can see there kind of a run rate. If you were looking at a run rate there, you're looking at, $100,000 roughly, a month over month. Okay, so that's money coming into the plan. And then the next couple of pages break down kind of the detailed activity by month and the number of transactions. Distributions on page 12. For the quarter, there were 54 transactions representing $575,000 in distributions, and they were all due to separation of service. Now, as a reminder, you've heard me say in the past over the last couple of years, we've been seeing an exodus, if you will, of people retiring, people taking their money and leaving and moving south and other tax beneficial statuses. I don't want to say that that's calmed down yet. People are still doing that, but a lot of people are staying put right now. A lot of people are staying put given their respective situations. And you can see for a rolling 12-month period, the different distribution aspects of this plan. So over the rolling 12 months, we had almost $2 million come out of the plan, $1.9 million in separation. There were 16 transactions, representing $28,000 for required minimum distributions. And another, unfortunately, one individual, almost $50,000 with a death distribution from that. And again, you can see the month over month transactions with respect to distributions leaving the municipal plan. When we look at kind of the investment strategy on page 15, we talked about the different components, and these are the assets tied to that. So as you can see, there are 19 participants utilizing the My Total Retirement. That's the professionally managed accounts, which comes at a fee that participants pay. So for those 19 participants, it represents about $243,000. I apologize. I've had a dry cough for the last couple of weeks. The largest percentage being the 57% or 243 participants in your target date strategy, representing $14.5 million, and 9% or 38 individuals in Goalmaker. which is the asset allocation, one person in a risk-based strategy. And again, 121 or 29%, 28% of the participants with a do-it-yourself of $14 million. Okay, so that's how we break down the investment utilization. On the next page, on page 16, just for comparison reasons, you can see active participants versus participants that have separated from service. And the thing here is that there are still participants that even though when they leave, they keep it in a plan. It is very, very common for people once they separate service to keep the money in the plan because they're either doing legacy planning or they just don't need it and have other means, et cetera. But they do stay engaged in all of the different strategies. 105 of those retired, roughly 200 and some odd people that have retired, are still utilizing a target date strategy, which is really important because when people retire, and again, depending on when you retire, 50, 55, or 65, people want to, through retirement, maintain an asset allocation strategy that suits their needs, right? So it's nice to see that there are still quite a few people that have separated that are still in the program. Advisory services, this is the managed accounts, just a breakdown there where we're showing the number of participants that started with the quarter. As a quick reminder, managed account services prior to Prudential were available. Then Goalmaker came in. Prudential didn't have a managed account solution. We were in the process of building one. And then, of course, when we got acquired by Empower did have it. So we put this in with our new program. And as you can see, there are 19 participants over the last couple of quarters. We went from 3 to 14, et cetera. So 19 participants and the corresponding assets with respect to the advisory services. And then on the next page, on page 18, is just a breakdown of the individuals and what services they're using. Excuse me, as an example, under 30, there are 7, 30, 39, 8, 1, et cetera, for managed accounts, online advice, individuals that are not utilizing it, for active and separated participants with some demographic data there as well. We're going to do the same thing for Goalmaker. Goalmaker has been since inception at Prudential. So as you can see, it's pretty much leveled out at 37 participants for quite some time over time, given that the majority of participants are in a target date strategy. So again, $1.4 million representing 38 participants in Goalmaker. And then we break it down also by demographics on the next page that shows participants by age group, how many are in it, and then what portfolio they're in. Are they conservative, they moderate, or aggressive, and the corresponding dollar amounts there. And the next 2 pages is going to be kind of a side-by-side, if you will. Remember, Goalmaker utilizes the plan's core investment options. So we break down the investments that are in Goalmaker versus non-Goalmaker assets there for you. Just as an FYI, again, total Goalmaker 1.4 million, the non-Goalmaker 29.3 million, representing the total of $30.7 million. And then the asset allocations by funds. Take a look across the board on page 23 and 24. All of your funds, number of participants as a percentage of the assets, and then the corresponding dollars in those portfolios as of March 31st. And for this plan here, as you can see, the stable value on the following page, on page 24, only has a 5% participation with about 100 participants in the stable value fund. And that is important because generally speaking, when you're talking about governmental 457 plans, tends to be a higher percentage of stable value assets. That's something that the industry has been dealing with to help people better asset allocate. Plans that were 50, 60, 70% today are more in the 30, 40% range. This is more like a corporate plan, 5, 10% of assets in stable value. And that's primarily because most of them are in a target date strategy that does not utilize Goalmaker as an underlying component. Then net transfers. And then the final pages on 26 and 27 is just a quarter-over-quarter plan insights. Just in time scores, number of participants, balances, et cetera, just data there. But generally speaking, and then the following page on 27, contributions, average account balances by age group, percentage of equity versus, assets in their portfolios, median lifetime income scores. And again, the lifetime income score, which I didn't cover, which is at the second page, is really like a replacement ratio. Melissa, if I can ask you to go back up real quickly, I'm going to close with this, and then I'll turn it over to Joe. On page lifetime income score, Melissa, on page 6, and I apologize. You can go
Sure.
back to page.
Yeah, no, that's okay.
So a lifetime income score, again, this is based out of 52 participants completing it. A lifetime income score is basically an income replacement, right? So you target 70 or 80% of your pre-retirement income to see how you're doing. So each individual fills out their own information and then a score is presented. So for this plan of the 52 that participated, and as you can see, the median and the average is 78%. The benchmark is 65 and 84. So that's pretty good for the people that did this. The more people that utilize the tools and do this, will provide better numbers to you to see how they're actually doing against the goals of 70 or 80. And for those of you that are in these plans, I encourage you to go in, not only register your accounts, but look at the tools, utilize them. The more you utilize them, the more you engage, it'll better suit your needs and give you a more specific situation based on your demographics and your data and your input, right? Because you could put a lot of these assets as you could put in your spouse's, your partner's assets in a lot of these calculations. There's many tools out there that helps you and guides you to make sure that you're achieving the best retirement income possible. So again, overall, $30 million, now up to $31 million now, $31.2 million. And the plan's continuing to progress. There's nothing here that sticks out that says this is of concern.
If I could add one thing. And
Sure, please.
You can get a drink of water too.
Thanks.
One thing that might be helpful for everybody to notice is that one of the things we're talking about this with RV Coons. We're very proud about, you guys have set up a plan that participants are sticking the course, as Gabe said. And proof of that, just quickly, is if you look at page 9, you don't have to go to it now, but page 19 talks about Goalmaker. More people are in it this year than were last year. So people aren't getting out. So in order for a person to, if they panic and they get out of Goalmaker, that's when you see the number. So you'd see people getting out and moving their money elsewhere. Same thing on page 23 for your target date funds. The number of people that are there this year versus last is very, very sticky. So those are people that we tend to see when you do see more of the volatility, it's not from those people, right? So the more people that are in an asset allocation tool, the proof is there that they stick to it.
Yeah.
So kudos to you all for kind of having those options available, because we see that play out. I'm sure we see it elsewhere as well, but you could look at it proof-wise on page 19 and page 23, something at some point to look at. It's very
Thank you,
important.
Rob. Are there any questions before I turn it over to Joe, who's going to give us a quick snapshot of the markets and specifically on your investments? I want to make sure I keep within our time frame. Anyone? Thank you. I apologize for the rapid fire here. Joe Fine, you're up. Please, investment report. Have at it. Thank you.
Absolutely. Hello again, everyone, and welcome to the new members and folks from RV Coons. Look forward to working with you as well. Presumably you could see my screen, correct?
Yeah, Joe.
Okay. So the story of the quarter, and it continues through current day, is tariffs, right? So and as a result, probably heard about the negative GDP growth for last quarter. That results purely from, because of the way the calculation is done, it results purely from the high level of imports, because companies and individuals bought in advance, if you will, did more importing to the tune of, several $1 trillion than they normally would have in the first quarter. So that really accounts for the slowdown in the economic activity. Good news since the end of the quarter is that tariffs got delayed, and I'm not going to turn to it, but one of our slides talks about slide 13 on your own, whether or not tariffs, the threat of tariffs was a negotiating tactic. I do want to point out that as of the end of the quarter, the S&P 500 was down 4.27%. Gabe referenced the volatility, and I'm presuming RV Coons might speak to this as well. We reached market lows on April 8th, and from April 9th through Friday had massive rebound in equity markets to the tune of 15 to 20% US, depending on what market segment we were looking at. But no, through yesterday, S&P is down 4.26% year to date. So virtually the same return that we had as of the end of the quarter. There was a lot of volatility in between, certainly. Just a look at some of the numbers. I'll blow this up here. You could see the negative returns for the quarter and growth underperformed value. Right, this has not been the trend over the past number of calendar years, with certain quarters excluded, if you will, certain time periods excluded, if you will, a result from MAG 7 issues and IT and consumer discretionary, et cetera. The slowdown in growth and IT specifically impacts a couple of your funds. So that's why I'm highlighting this right now. We'll get to that in a minute. I know time is of the essence. Other thing to point out for the quarter, international outperforming US. So that, that it hasn't happened for some time either. Fixed income side, positive quarter. Also very choppy since the end of the quarter, but we're pretty much in a similar place as we were at the end of the first quarter for fixed income instruments. So I am going to jump to page 30, and we're not going to go over all of the funds in the plan, but for those that are new to the way we do this, we speak to the funds that have underperformed. We start by speaking to the funds that have underperformed for the 3 and or 5 year timeframes, whether that be both benchmark and or peer group. And the funds that we speak to are summarized on page 36. They're very brief comments about each of these 5 funds. So those are the ones we're going to clear and go over. Fidelity Government Income, you could see a lot of noise in the 3 and 5 year returns. Good news is 1 year isn't as bad relative to benchmark or peer group. And for the year to date, or that 3-month time frame, first 2 columns, fund is doing pretty well. So there's often very tight returns from the top to the bottom of this peer group. So no concerns. Also, the fund does have a longer duration profile relative to the peer group, but does exhibit similar risk characteristics. So haven't had an issue with this fund strategically, if you will. Bottom of page 30, top of page 31, just to clear it, Fidelity Advisor Freedom Income, noise for this vintage and the 2010 vintage for the 3 and 5 year time frames. But you could see a vast improvement for the trailing 1 year and the year to date. And this continues through yesterday. The entire series is at or near the top of its peer group, regardless of what vintage we look at. So I did want to point that out. On page 32, towards the bottom of the page, the Domini Impact Equity offering, you could see is behind the S&P 500 index, but this is your socially responsible option in the large cap equity space. And you could see a good 1 year peer rank, as well as being ahead of the peer group for the year to date period. This fund also is in line with peers at this point in the cycle. And same for Fidelity Government Income. I failed to mention that about the improvement since the end of the quarter. And then finally, at the bottom of page 33, the Columbia Acorn International. This fund specifically, fund management highlights the tribulations in the AI space specifically, and as well as industrial space. So there has been underperformance here, but since the end of the quarter, the fund has rebounded tremendously. And even the as of today, as of yesterday, I should say, the 3-year rank would be in the top half of the peer group. So the fund has been rebounding, as is the case for the Impacts Global Environments Fund. Really, for 2024, some improvement in the first quarter, even though it underperformed. But since the end of the quarter, doing really well, and the year-to-date result through yesterday would be in the top half of the peer group, but not improvement in the longer-term results. So those are the high-level comments. I will stop and pause, make sure there are no questions or comments from anyone in the conference room.
We are at
Okay.
3:01. Just saying. Just saying.
Not
I was
that's a
at-
competition already there.
No, but I was asked to hit the target. I pretty much hovered it.
You don't get extra points.
No, I give you the minute.
I was the minute?
Yeah, you were the minute. You should be eating that cookie.
Yeah.
No, in all seriousness. So, thank you. Thank you on behalf of all of us at Empower. Happy to take any questions. We appreciate the opportunity to serve your participants in this relationship. Thank you.
I just eat your cookie.
Thank you. I appreciate you. Thank you. Very nice of you, Corey. Thank you.
So now very pleased to welcome the folks from RVK. Everyone remembers it was it this time last year? When you were president?
Yeah.
It was about this time.
Earlier, yeah.
Yeah, when we brought RVK on to sort of do a one-time baseline look at our plans, help us kind of think about some ideas for the future, governance enhancements. And after reviewing what they advised us on, thinking about, what tools we had in-house, we went out to do an RFP to bring an investment consultant on board. And so we're really happy to have locked down RVK to perform this work on an ongoing basis. And so today what we thought we'd do is kind of reintroduce you to Jonathan and Sarah. I know most have met them before. And talk a little bit about the work plan that we're thinking of doing. And they did also put some brief commentary together on some of the market volatility we've seen. So with that, I'll turn it over to Sarah and Jonathan.
Perfect. I definitely appreciate that warm introduction, Tim, and really a pleasure to be here with you in person. I know that there were several different virtual exchanges of information over the last several years, but as Tim mentioned briefly, RBK is an independent investment consulting firm here to support the boards and staff with an ongoing fiduciary evaluation of the overall programs, both investment and supporting in partnership with your other stakeholders and partners like Empower, the work with the overall plans. And so Sarah and I are the core members of the consulting team, and really are going to focus today on the strategic vision and that will guide the engagement that we will have with the plan on an ongoing basis. We're thrilled to be here with you all today. Obviously thrilled to deepen the ongoing relationship after the project. I think you got a taste of some of the specific areas of focus that we've provided over time, but we have a methodical approach to having a structured, well-documented, well thought through set of engagement approaches, and obviously are flexible to that. We've put forward some specific thoughts around what we identify as kind of the shared vision and kind of shared points of focus, but we're obviously flexible and look forward to working with you and staff on kind of guiding that development. Specific to this point, we've listed 6 areas of focus that aligned with the RFP framework and aligned with, frankly, our view of best practice work plan approaches. I'll briefly walk through these, but then Sarah's going to dive deeper into the specific approaches that we've identified as some of the initial areas of focus, and we'll obviously happy to solicit feedback and kind of discuss kind of areas of alternate approach. The 6 areas, just briefly: enhancing participant outcomes. This is effectively looking at plan enhancements, looking at fiduciary support that guides specific targeted focused areas of improvement to things like governance and oversight processes, board training, investment policy statements, the like, if you will, in this, working hand in hand with staff and your plan partners like Empower on plan activities, demographics, getting a better holistic sense of the guiding principles that indicate kind of the direction that both investment and non-investment recommendations can and could take the plans. Evaluating the plan's competitiveness as a second topic. Really, this is based on monitoring, assessments, and benchmarking. And effectively, this takes a look at the fact that you don't necessarily need to compete with the Joneses, if you will, but being aware of what others are doing and understanding how you compare in that comparison is important to be able to look at various things like fees, like your outlook and kind of approach toward things like, potential plan enhancements, plan amendments, other areas, just giving you some of that perspective in tandem and in partnership with your internal staff as well as other stakeholders. Providing support for administrative functions. Fundamentally, you have as you saw in the report, a highly qualified administrative provider partner in Empower, looking at vendor capabilities and assessing critical areas of potential utilization, focus. There's opportunities, and providing monitoring and operational support of that is a critical function of what we're doing to help provide ongoing support and efficiency to you in that engagement. Moving forward to the fourth, providing consolidated reporting. Ultimately, you have a lot of different reporting components, and obviously from the standpoint of being able to get tailored reports that summarize key plan metrics, we don't want to necessarily repeat information that you already received, but we do believe that it's important to have a facet, and we believe we have an additional unique point of view and perspective in that, and we will strive to put forward a very specific focused area of informational presentation that will support these discussions.
I highlight that point too. Power has a really robust reporting tool on their employer sponsored portal, and they provide a lot of information, just as you see quarterly. Sometimes there's so much information available, it becomes hard to figure out what's the most effective way to communicate that to this body. And that's something over the course of the next year or so, I really want to prioritize understanding, trying to distill that. Sometimes I wonder if we're getting the right things to folks. And so any feedback from board members as we move forward, as you start to become used to RVK's reporting, that's one area that I'm particularly attuned to and very happy to have any feedback on.
Yeah, and we're excited to work with you and make that as an effective process as possible. In that vein, number 5 and number 6, just briefly looking at improving participant education and communication services. We're not directly delivering participant communication, but working with your staff and your communication vendor partners in that. We have observations about what we see in other plans and look forward to bringing to bear kind of these comments and points of view about that to help empower participants to make a high quality and effective decision throughout each step of their retirement journey. The last one, really looking at reducing participant and plan expenses. Reducing is not necessarily perhaps the only objective. Maybe it's optimizing, because there's a value objective there as well. But from the standpoint, having competitive and reasonable terms with all plan providers, and where there are opportunities with value in mind, to have cost saving opportunities and transparency. Those are principles that are core to what we view as a critical mission statement. So I know Sarah's going to walk through some of the specific near-term areas of focus.
Yeah. And like Jonathan said, it was a privilege to have worked with you all ahead of having this relationship, because it gave us having done this comprehensive review really helped us understand a lot more of what your objectives are and the needs of the plan. So give us really a head start now that we're thinking what should be the strategic plan. It gave us the ability to think, okay, we really have enough information to at least put an outline, working with staff to outline maybe just broad strokes of what focus areas can be for the plan. But as Jonathan said, our goal here is really to get all your feedback, because you all know your plan better, you know your participants, you know exactly what you need. So even though we have an inkling based on that review, our hope is that this will be a collaborative effort. And as while we're going to present some ideas here to you, we hope this will be a dialogue and we'll get your input, which will really drive us forward. So I'm going to quickly walk through some of those ideas that are in front of you. But for the sake of time, I'm going to keep it very high level, and I'm going to actually maybe move to the next page here that really shows a laundry list of items that you don't really need to read right now. But basically, I think what we really wanted to do is to identify focus areas that we think we really can prioritize or should prioritize over the next couple of years. Some of them are more process oriented, like what Jonathan said with developing an investment policy guidelines or developing a process to conduct manager evaluation and document that process and policy guidelines. And then others are more areas of review that we have already discussed with you all last year that we think maybe are worth taking a closer look, like looking more closely at the target date funds or looking at the investment menu, for example, more closely. So these are areas we have already talked about, but we think they are worth taking a closer look. And then we try to pull all those items into an agenda. And now we discussed with staff what we all think might be the most logical way to sequence items, to start with items that we think maybe are more foundational, that will inform everything else that we may recommend. And we highlighted those items in green. So things like doing what we call a retirement readiness review. And now this is really a deep dive into the plan demographics to understand the retirement adequacy of participants, looking at every source of income available to them, their saving patterns, how they use the plan, and help us understand the role of the plan for participants. And we think this will really inform everything else we look at, including what the investment menu should look like, for example. Another item that we mentioned is as foundational is looking at the investment policy and the governance process more closely. Again, this will inform everything else we do, so it's really important to start with this one. But then there are also other items highlighted in green here that we will be working, or we propose working with staff on throughout the year, such as doing a plan fee benchmarking. Some of those items may not make their way into your agendas just because we can't really, we don't want to take over your agenda completely, but we'll be doing those behind the scenes. So maybe establishing a manager monitoring dashboard, looking at managers more closely, identifying opportunities to potentially move to lower cost vehicles of your options. And doing a plan fee benchmark is another one that we're proposing to do this year. And ultimately, I think our goal is to really not have a hard plan, but have a living document that as we start working with you all, that it will evolve based on your feedback, based on what we learn. And it will likely and very likely will change over time and to kind of adapt to the needs of the plan. And I just want to end here by saying, based on our work with you, we know that you and staff are really working hard and with support, great support from Empower to provide folks with, efficient, cost-effective options. And our role here is, having worked with so many other plans who are trying to do the exact same thing, is to just partner with you to help you all achieve those goals. So not to spend a lot of time here, I really wanted to emphasize that our hope here today is to, not just today, but hopefully throughout the year, is to get your input, get your thoughts, and have a dialogue and make sure that we're heading in the right direction and, heading on all those items that are really important for you all. And anything else?
Yeah, one of the most helpful aspects about having RBK on board with us, we have deep knowledge of these individual plans and zero knowledge of other plans that are, other states have. And so having folks that can kind of tell us where we're situated against peers, I think is one of the biggest values that we get from this excellent team. As this presentation today is brief and meant to be very high level. One of the things I really like about this slide is that it has a lot of stuff for board members to think about. And if there's something on here that you're either like, what is that? Or I think this is important. We are all ears. So, feel free, we can bring it up we can have a subsequent conversation in a board meeting. Feel free to reach out to me individually. But areas where you think there might be value, the goal here was to put some ideas on the table and then see where folks think there would be some value to focus on that. And we'll be providing our thoughts as we go along, obviously in tandem with RDK. But the most important word on this is proposed. It's not final.
Yep. Yeah.
So
great.
Yeah, and I think that just as even zooming down in, just to give you a little bit of additional color, then the next slide, I think actually gives a even just at a zoomed in level of kind of what obviously May is right now, then looking at additional perspectives in August and in November timeframe too, with inception of performance, governance, investment policy, and then forward plans. But once again, those are proposed.
I had definitely, as we were going through the initial piece, investment policy statement, I was trying to, I know we have that on the BPIT, but I didn't, and sorry if I should know, but I didn't know if we have an existing one that we're looking to update, or if this is just a newer space for us from a governance standpoint that hasn't been something that existed before.
Yeah, it may have in the past. We're looking to really develop one from ground up at this point and try and make sure that we, there was, as like this has been from the period when we did our, what was it, 2017, when the relationship started.
Correct.
We brought on Prudential, then brought on, then that transition to Power. We've had a lot of internal changes here. What we're really looking to do is start from ground level and build one.
A little bit eye-opening in the VPIC fiduciary training that we had recently as a board, where the landscape on lawsuits in the universe and fund picking on DC plans, and it was pretty alarming. And I think would be pretty important that we have those policies on hand and are using those to guide our decisions, and maybe our watch lists or whatever other appropriate oversight a sound policy will provide, I think is pretty critical. So I'm sure you're aware of the lawsuits that are out in the universe. So
those ideas and concerns are what animated our original relationship with RDK. We were very happy with the results, obviously, of that review, and this is to really build off of that.
And that is why we're prioritizing governance and investment policy development. So I think staff is exactly in that same place.
And I think that you don't have to make perfect decisions, because I think, a perfect foresight is actually impossible. But at the same time, having a thoughtful, well-documented process that lays out a framework that is defensible and well documented.
I think that piece, which I'm not sure on this list, but the proxy voting policy, obviously, first, but that proxy voting policy, I think, is so pretty critically important.
Yep.
If we intend to vote our proxies, which.
And each of these, you'll be sort of benchmarking them against other plans, policies. Like, is that kind of what you're going to compare your recommendations to learning and best practice from other plans? Or?
Yeah, that is one of our inputs. So we definitely, we try as much as possible to make sure all our plans are aligning with what we think are best practices, documenting the roles and responsibilities, documenting all the great work they already are doing, frankly, most of the time. So, so it will be informed by those other plans, but also we like to make sure it's also reflecting your specific plan, because every plan will be slightly different in their own needs. And yeah, so definitely we'll do that also.
And what other plans are you thinking that you would compare us to initially?
So I would say, identification of peers is something that we would be looking forward to, working closely with you, and staff, frankly. But I would say that in this, it perhaps is, I think the first input perhaps maybe less, isolated, individual plans that might have, specific idiosyncrasies that you might, unless there's a specific guide that you want to kind of specifically target. We actually think that starting from first principles and ensuring that there's a thoughtful framework and identifying the areas of commonality, and then identifying if there are specific points where, for instance, an investment belief or an approach or a strategy for inclusion or exclusion, because those both are active decisions that can be made in the governance framework, that those are thoughtfully taken into consideration. So,
and RVK also is our consultant on VPIC, and the investment policy statement work there and the proxy voting work has been reviewed recently. I understand that in the institutional, choosing individual accounts in a DC might be different, but I think probably worth reviewing for the commonality of language and values represented in policy would be helpful. And layering that on top of maybe model policies that make sense in a DC space.
Absolutely.
Great. So we actually, maybe if there are no questions, we can pivot to a topic that staff really good for us to cover, something that's on everyone's mind, which is with the new administration. We have all been, mentally preparing for this time, but I think the market volatility, I think, is in line with expectation, but perhaps some of the more ambitious policy, recommendations and guidelines, I think, are maybe exceeded our expectations a little bit. So Jonathan and I are going to walk you a little bit through that.
I think that, and I think Joe and others certainly give a comment here. So we're not gonna beat this too much, except for providing a taste of some specific governance principles and thoughts and actions. I'll give some recent marketplace context, some updated perspectives on market timing, perspectives on behavior that we've observed, and some general guidance that we have for similarly situated folks. And I think it's appropriate for individuals too. So specific on this slide, obviously it's a volatile market climate. I'm not going to read each one of these boxes. I think that it's been quite a ride. I would say that some of the days that were particularly momentous were the 3rd and the 4th. Mega decreases, if you will, that were offset fairly immediately, the next trading cycle with reversals on policies. This is, Sarah may have said that these were, as expected. I would actually say that there was some pretty unprecedented situations. I think that market movements are challenging, and I think that we each see those in our individual portfolios, as well as obviously as oversight and fiduciaries on plans for other people's money, participants' money on this, understanding that you're empowering them with tools that support where they're going is really important. So with this market context, we've provided some additional context. Is this truly unprecedented? There's several different examples of other market declines and duration of market declines that are instructive and helpful. The red line there is bolded there by purpose. That's the one, not quite as steep as COVID, which was the purple one there, but effectively, if we look at this, the recovery since this period, I think with the slide print on this one, there's actually been some improvement further on this. That red line would have come back up somewhat to to the points that were shared earlier. It's kind of in that 4 to 5% range. So it's come back somewhat, but it's been a very volatile period. I think that goes without saying. Page 4, I think that risk of market timing, I think some practical perspectives that we would share with you is that no one can predict the future, but what we can do is we can look back at past patterns of market performance, and we can look at the fact that in these various cases, various economic regimes, various climates, various points of what sparked market volatility. What is true, with I guess one exception on this, where there was a 1-year period after the GFC and kind of some of the depths of the GFC on this, with one exception, you universally saw rebounds that if you had stayed the course, this was actually it was important not to just go to cash in that vein. And that 1-year return, it's hard to say what the 13th ranked one, which is the 4.4 one here over this, but hard to say what it's going to look like in the future. But we think it's instructive to look back at some of these historical points of view. On the next slide, this is actually a useful contextual slide that we share with clients, and we discuss internally just from the standpoint. Yeah, if there's market timing requires to be perfect. If you were to be a perfect market timer, it requires at least two decisions: when to get out and when to get back in. And perfect market timers, maybe there are some that have gotten it right at this point, but if you miss just several of days in very long time periods, you can miss out on a ton of performance that is hugely detrimental to long-term retirement or just investment performance. So over this 20-year period, 7.7, you missed 5 best days of that, you lost 2.5%. If you missed the 10 best days, you lost 4.2%. And if you missed just the 15 best days, you lost 5.75% of that performance. And obviously, those are not sequential. Those are not sequential days. So it's a little bit of, it's illustrative from the standpoint of, it just gives you some numbers that kind of go into the practical perspective of, I don't think anyone necessarily would say I can pick it, but it's just human behavior of saying, I know when something's going down, I know when something's going to come back up, but if you put yourself into that actual situation, it's very hard to get back in. And so that regret you would end up being observing in these specific bars. And so with that grounding, wanted to provide some comments for Sarah to say, what are participants doing based on what we're seeing on some of this data? And
yeah, so it's really great that given what Jonathan just said, that we're not seeing a lot of activity like Gabe just explained, that participants are staying put. Most folks in your plans are already invested in a asset allocation strategy. Most are in target date funds, so they're not making much movements, which is what Gabe just described is really about the Empower record kept plans, is what we're seeing across all other plans. The record keepers shared with us similar data from their plans as well. Most folks are not trading. Most folks are not reducing their deferrals. It's a very small minority. There are some that are trading into mostly safe assets. There are some younger folks that are, trying to buy the dip. But for the most part, folks are, knowing that these are retirement assets. They're not supposed to be touched, and they're not doing much to really change their investment philosophy or allocation. And which is really great given what we have seen. You can see on the chart here is that the majority of asset classes in Q1 have really shown that diversification really helped in the first quarter. Really, really something we're happy to see. And sometimes we've talked, with clients for a few years about why it's important to be in international equities or to be, outside US equity, frankly. And it's been a tough conversation some years, but in a year like this one, it really makes the case of why that pool is really important. Because in Q1, we saw a lot of asset classes and markets that have historically underperformed, really carrying the portfolio. And then similarly, we saw something similar in April 3rd and 4th, where if you maybe had some allocation to bonds or some allocation outside the US, it provided a cushion and your portfolio really outperformed someone who was aggressively invested in US equities. And ultimately, I think last thing we wanted to touch on is plan sponsors understandably are asking, what can we do? There's a lot that's going on. There is a lot of changes that seem to be sweeping, seem to be drastic. There's a lot of uncertainty, and what we like to remind them of is that you're already doing a lot of great things. Yeah, keep doing what you're doing, upholding your fiduciary duty, doing your regular investment reviews, and documenting the decisions you make is really important. No big changes or important changes will be made overnight just based on the news you saw last night. So changes need to be strategic and need to be looking at the long term, because these are long-term retirement plans. Second thing you can do is make sure participants are receiving communications, and we know Empower shares a lot of communication with folks about market volatility, importance of being diversified, importance of trying to avoid market timing. So that can really help. And finally,
before I go there, that's one of, I think, some of the greatest value Empower brings with our dedicated Vermont team. I think Chip, led by Chip, is really, they are talking to our members more than I think a lot of folks appreciate and know, and I think doing a real great service to us. And so can't stress that one.
Great. And then lastly, I think that it's really important to maybe use this as an opportunity to observe how different investment options in your plan are reacting and responding to market volatility. And this can shed some light on maybe their ability to provide downside protection. You're already giving folks a diversified menu of options. So you're already giving them the tools to build portfolios that can withstand a market like this. Looking at those funds more closely can help, making sure that you're monitoring participant behavior. So RVK and Empower can provide an update next time we meet about how participants are responding. We don't expect anything drastically different from what we've seen so far, but monitoring participant behavior can maybe shed some light on what we can do, and if there's something that we need to communicate about more or to clarify. And then finally, this may be a good opportunity to think if we are making any changes to the plan, or if we're making any updates, maybe to take into account that markets are volatile now. So something with our clients is maybe no need to have a blackout period for 1 month while markets are really volatile. Maybe let's hold off on making changes right now if we're making any. But in your case, there are no planned changes right now. But just always, keeping that context in mind while you're making changes to the plan is really helpful.
That's largely why, really happy that the board is kind of taking a proactive look with the RVK relationship, bringing them on board, getting these wheels in motion so that we find ourselves here, we're able to have a thoughtful discussion rather than, oh, let's panic, find someone. It's been a really good past year on that front, and I'm really excited to carry that forward with both partners, really.
Thank you, Tim.
The shared sort of ranking for each of those underlying accounts was interesting to look at, and it has me thinking about, as we're developing investment policy statement, and you all highlighted some that maybe were less optimal performance, that we sort of align our thinking around watch lists or take on your best practices, articulate it in policy, And then we have a platform for when we're considering these things, whether that also speaks to the idea that in times of market volatility, our policy says we hang tight and we pay close attention to the watch list or something like that, whatever it is. But I think I really appreciate us as a body putting that in writing and having that guidance.
Yeah, and I think that one of the other things, and we're excited to be able to bring this forward with you in a similar way to the information that was shared as part of the plan review and investment menu review, is really effectively both performance, so like the quantitative figures, but also the qualitative components of conviction and investment strategy, conviction in a manager's, if it's an active manager, their sector or stock selection ability, and potentially the stability of the team. If it's passive, is it the correct or the best or optimal benchmark for a given exposure? Those types of discussions that obviously critically relate to how the investment performance is experienced, but may not be as immediately apparent on the page. That's something we're looking forward to bringing with the monitoring dashboard.
So, yeah, so as you go through the strategic plan and all the items we have there, just, let Tim and team and us know if there's any ideas or feedback or items you want us to focus on. Looking forward to the partnership.
Thank you very much.
You want to sneak up here? Please not to move. Please stay right there. Oh,
okay.
Now, excuse my technical abilities here. I'll see if I can.
Now we'll change gears to MRHS plan. This is a plan that, I don't know that, in my time, we've never had someone from Optum or BPAS actually physically into a meeting. So I'm really glad that Jeff made the trek, and quite a trek it was. So is that this presentation, well, Justin will tell us later when we finalized our contract with Optum, but it's relatively new, and so the relationship's been developing over the past year, and it's been a really productive one. So, Jeff, thank you.
Tim and board, thank you very much for the opportunity to speak with you today. They are saving the best for last. I will say, I don't know if I could totally make claims adjudication super exciting for you, but it'll be my attempt for the day. I do want to introduce Optum Financial. As Tim mentioned, I don't know if we've ever had that chance to be here before. So if I'm the face of the company, I apologize for that, but I'm super excited to be here and talk about the service we provide. So Optum Financial, our focus at Optum is to make the payment process for claims and accessing your funds, which I would really compliment the state on putting together for participants, as simple as possible. And we've created a network that facilitates that process with a participant at the center of that experience. And that's really what we're focused on doing. Our tagline, and there's a little video here, but I will, in the interest of time, won't play it, is paying health forward. Really, we occupy kind of a unique component in the payment and healthcare space, and our objective is to excel at making that process simple, easy, convenient, and most importantly, fast. We know at the end of the day, especially with a benefit like this, nothing makes a benefit feel less like a benefit if you can't get your money out of it. So you've gone to the work of creating a plan that's tax advantaged, and it's our objective for you and our responsibility to make sure that it goes well. So some comfort as to who Optum is. We are an organization that has some capabilities in the marketplace. Our payment rails process $500 billion a year. We serve 25 million consumers, 2.2 million providers. That's going to give us some access. We have both consumers, payers, providers built into our network. And that's why we feel that we can have a pulse on how to make that process work a little bit better. And then most importantly, our side of it is the consumer side, making sure if you're an individual that uses Optum financial tools, that the process is simple as possible once it comes to healthcare, at least. An overview of the plan, just a quick overview of the plan, and I'll just take a quick aside to compliment you, is that I don't know if everybody talks about healthcare expenses that much because it's a big number generally. Fidelity has been tracking the number for like over 20 years now, and I think this year's number is $156,000 per person from 65 until we're no longer here, and that's double for husband and wife. It's gone up 5% since last year, and since they've been tracking it, it's gone up. It's doubled. It's doubled. So just truly, this benefit you have created can be incredibly useful for the participants that have it due to the tax treatment of the plan. So this is my favorite slide because I think it really tells the story of where we're all going to be at some point and why this program is so useful is we're all going to enter our retirement years and incur non-insured medical expenses and insurance premiums. We will, just will, if we're here. And this type of plan provides a tax-free source of funds to pay for those expenses so that you don't have to use the other things, like the things you guys are talking about today, deferred comp, pensions. As long as you have this account, it's exhausted, you can use it to pay for those expenses. And the next thing, that the triple taxation is why it can be so powerful. So the money goes in tax-free, it can be invested and grows tax-free and comes out when you pay for your expenses, you'll never be taxed on it as well. So if you ask for $50 in a year or $50,000 a year, you're never going to receive a 1099. You're never going to get a tax document. Your employer has set up this plan specifically to meet all the criteria so that that benefit is totally tax-free. And then where we come in is that payment process is that the IRS giveth, and they also require that these types of plans must be fully adjudicated. So they're not going to trust you. Your plan sponsor has to put in place a mechanism so as you incur those costs, it's confirmed that it's a qualified healthcare expense, and that's what we do. That's our, and we do that by providing like convenience of a debit card, online tools down to your mobile phone, online, and then if you have people that still want to send us paper, we'll actually take it. I promise you, we'll take it. This talks a little bit about the plan, and Tim probably has shared a little bit with you. So this plan was created to set aside money in a specific time frame. It's a closed plan now. There's no new members into the plan. It was created specifically for the reimbursement of medical expenses. And then the types of expenses that are reimbursable are per the IRS tax code. So it would be all those things you would think of, but also most importantly, premiums. And that's pretty small. So I like this slide. So what does it pay for and who can it cover? So it can cover health insurance premiums, COBRA, Medicare, of course, dental and vision, long-term care insurance premiums, which I don't know if that's always a topic of conversation, but a kind of a neat thing if you have a big account balance, co-pays, deductibles, prescriptions, other out-of-pocket expenses, and the account holder, of course, can use the account. But if they have a spouse, they can use it for their expenses. And if they have qualified or eligible dependents, they can use it for them as well, all totally tax-free. The team that brings this to you is me at Optum Financial, and we do all the things that are listed on the left-hand side there. So we do all the front-end retiree health savings, participant website services. We have 24/7 call center support. We provide debit cards, an SSO from our platform. So if you're in our environment at Optum and you want to go to your investments, you don't have to re-authenticate yourself. There's an opportunity just for you to SSO right over to the partners at BPS to see your investments. And then we provide all the claims adjudication that is important to you, from cards to online to mobile, picture to pay on your phone, all those sorts of things. And then we have partnered with BPS from inception, and they operate as the custodial and investment advising partner for this plan. And they're the ones that do all the things that was kind of talked about today from an investment standpoint. Optum is the record keeper from a claims perspective, but not a record keeper from the investment standpoint. So BPAS, also sometimes known as Health Hand Benefit and Trust, is the company name. They provide the trustee custodial investment lineup and then manage the platform that your participants go to change their investments. Because as a reminder, there is an investment lineup that is made available to participants, and each one of those participants can individually select how they want to have their funds invested based on their risk tolerance and time horizons and all those things, like they would for any of the other accounts. I did want to share a little bit of information, just kind of as a summary of both the population and what we see from spending. Now, I have contributions on there, but I just want to reinforce that this is a slide we use for a lot of our relationships. There is no new contributions into the plan, but there is spending in the plan. So the total population is about a little over 3,000 folks. The dormant number is actually individuals that still work for the state but can't access the plan for claims. So they have an account, they have money in the account, they can change the investments, but they can't submit a claim until they have left the organization and met qualifying criteria. The blue is those folks that have actively retired and left. For last year, for 2024, there was 507,000 approximately dollars spent in expenditures. 88% of those were electronic claims, which you would expect. And then there was 12% or so that were manual claims. And so those would be ones where they would either go online to their account and submit claims and upload that. And we'll show a little bit of example of how that works. Or they send us a paper claim as well. Tim did ask, and I didn't forget. So Tim, you asked, what did it look like maybe for like prior years? So I went back for the last 3 years. There was almost $2 million in claims paid over the last 2 years for the healthcare expenses for your participants. The average for those 3 years was about 631,000. The average number of claims over the 3 years was about 5,000 per year. And that gives you an average claim number of $125 per claim. Now, the interesting thing too, and I didn't necessarily bring it forward in my mind until Tim and I and Bill were talking a little bit, is this is a closed plan with a certain amount of money was made in the plan. There's more money in the plan now than what was contributed initially. So it's been a really great opportunity for your participants because they have had the opportunity, I think of it, to use it and save it, because they've been using the money all along since inception, but the interest earnings on the plan have actually made the plan have more assets than when it started, even though they've been using it at the same time. So really probably what you would absolutely hope for with a plan to do. The next one, just a quick claim summary. 96% of those claims were paid automatically. Now, that denied claim count sounds like an angry word. Okay, we're not going to pay you. Well, part of our responsibility is to make sure that we do truly make sure that these are qualified healthcare expenses. And sometimes we just need some additional detail, to be honest with you. It's usually not a hard no. It's just we need additional detail because we do need the data service, type of service, patient responsibility, all those sorts of things. The breakout of the claims was a little surprising to me, because if you were going to ask Jeff Gilson what I would think the number one expense for a retiree would be, is I would say premiums. And I was exactly wrong. The number one cost is pharmacy expenses, and then medical, vision, dental, and then health insurance premiums was last, actually. These have historically been a very useful tool to help pay for premiums, both pre-65 and post-65. But at least currently, premiums is not materializing as a large. And then I just want to say, just a quick call out on that denied claims. Really 2%. That there was only two ineligible claims that were truly not paid. So at the end of the day, generally our participants understand what qualifies. Sometimes there's a piece missing. Sometimes they have to go back and ask for additional detail, which is never fun from a doctor's office or service provider, but very few of it is denied.
Frankly, I'd be worried if there wasn't some measure denied that Jeff's team was doing the job of actually reviewing it. So it's
rubber stamping everything.
Yes, somebody that's comforting.
And then the next piece I wanted to show, and I probably stole a little of my thunder here, is that this is the current asset totals. These numbers are provided by our partner at BPAS. As of 12/31/2024, there was $13,420,509 in the plan allocated across those investments. Those are the investments that are made available to participants, with 13% into equities and 80% in the balance fund that's made available for folks. And I think the number of members initially the funding in the plan was about $8,500,000 or thereabouts.
Sounds about right.
The return to the plan, as of this time frame was 9.74 with corresponding 1, 3, and 5-year returns. So, 2024 is a very good year at 9.74. The 3-year return is 1.99, and then the 5-year is 6.96. I would say I would defer to other people that are probably investment experts, but sometimes we do see people being slightly more conservative in these types of plans, maybe than they would be in other plans. Due to the fact that they really wanted to be there to pay for their healthcare costs, they want to see some growth, but they might not be swinging for the fences with this account where they might with other accounts. And then additional detail on total balances on what you can see over the last 1, 3, and the last 1 year, 24 months, and 36 months from a balance perspective. You'll see 36 months ago was $14 million. And there has been use, and then, of course, investment probably as well. So we ended up most recently at 13,425,10, and then shows the average participant balance over those years as well. I know I'm going pretty fast. The other piece I just wanted to hit upon real quickly is how does the individual access their account, and what happens when they become eligible? Just a quick overview. So you're going to tell us when the individual moves from a dormant to an active state where they can start to submit claims against that. We'll send them a welcome kit that welcomes them to the plan. That welcome kit includes the debit card, which is probably the predominant way people access their accounts today. But they can also use their mobile phone or Optum Financial mobile application. They can submit paper claims. And then the last piece we see a lot is recurring premium opportunities. So you can set up recurring premiums so that you can do it once, sort of set it and forget it, let it run for a year, and then visit again, because most likely the subsequent year you're going to have higher premiums. So you've got to visit it again at that point because you probably want to get the right reimbursement. Tim did ask me to give you a quick overview of what the participant website looks like a little bit when they're going to be making a claim. We're really making objective here is to make a landing page that provides good information, topical, but not too much. So on the far right-hand side, you'll see the key buttons we have to either pay a provider or to reimburse yourself. Then I want to make a quick call out too, is that you'll notice the balance of $9,681 is different than the total balance. What we represent in the balance there is if you're going to access your account via your debit card. We honor 90% of your total balance in case of market fluctuations, because you're going to be swiping your card at the point of service disconnected from what the market's doing on any given day. So we have a 10% float in there to help accommodate any market fluctuations that might transpire. And then the next slide shows if you were going to choose to be reimburse yourself, that blue button on the far right, what would it look like? Well, it's a guided journey where we capture the information that the IRS says we have to have from you to be able to eligible to reimburse you. So it walks you through those steps. That's an example of you reimbursing yourself. Here's an example if you were going to pay a provider. So instead of paying them and being reimbursed, you can just have us pay them directly for you if you like to. And it's generally the same information. And then the other one would be the recurring premium reimbursement process. Just want to really, as much as possible, meet your participants where they are. Because these are important accounts. And once again, we want to facilitate payment back as quickly as possible. And then if you were on our screen and you SSO to BPAS, it would look something similar to this. And the process has been working fairly well, I think. We are always improving, though, always improving. And the roadmap for 2026 is really these things, is we're really trying to simplify and magnify the participant experience so it's as simple as possible, and introduce things like AI where it works and technology that can make that process simpler and improve really all aspects, because this is where we live. This is the intersection we live at. And then just want to make a quick aside. We do have additional things we're bringing forward. This is similar to like the FSA or HSA store. If you want to use Optum resources to purchase those sorts of things, you sure can do that as well. Not a shameless plug at all, but just saying other things we're working to build out to make the process as simple as possible for folks. And Tim, I might be close. I might be right on the nose. And I will say this, I want to thank the board and the state for this program. I know they're sometimes a quiet benefit, but they are incredibly useful, I think, for the folks that have them today, and I would compliment the state for constructing it. So thank you for letting us support your folks.
You got any questions from board members on that? Gracious plan. Great.
Happy to answer any.
And I think that going forward, we are going to try to have a bit more of a regular reporting practice with Jeff. He's not going to come out for everyone. But
a little bit of a job, but not bad.
Yeah. But so we're going to be working on putting together something so we can kind of see this a little bit more regularly and have a better pulse on this. So thanks a lot, Jeff.
Tim, thank you.
I think Tim and Justin are going to bring us home.
Yeah, this one I'm going to hand over to Justin. There's not really a legislative update to speak of. I think we put this on all three of the board agendas. Get some other things for the state procedures, but from our perspective, it's been a quiet year for this plan over at the legislature. So I'll turn it over to Justin. The way we wanted to kind of finalize this was, we've heard from a lot of vendors today, and we thought it would make sense just to have a quick overview of who are all the vendors that we use, what are the contracts we have, and what is the upcoming work. I think this is a 5-minute. It's gonna have to be presentation as we're all finish up here.
Bill, can you put that on the screen for me, please? Yeah, good one. And I think the structure, I'll just start going until we have it. But I think the thought here was zooming out because you folks, the board tends to see contracts one at a time without zooming out to 30,000 feet. And so I think the thought here is zooming out and continuing, probably on this sort of quarterly basis to give folks an idea of what's coming up, how this fits into our overall sort of retirement structure in terms of contracting. And so the important thing is to know, we have contracts for a whole bunch of services, actuarial, record keeping, outside counsel, IT platform hosting, like with LRS. And generally, we have to follow very stringent policies set by state with BGS. We have to go through Attorney General review. So there's sort of this, you don't necessarily see the back end, but normally it's RFPs, it's, or simplified bid. And so we have a lot of structure on the back end that's built into the sort of staff bringing things to you fully vetted, fully knowing they're going to be approved, because it doesn't help for the board to decide they want to head down a road. And then we're like, oh, by the way, this will never get approval from, the 5th floor of the AG's office. Can you go to slide 3, please, Bill? Back one, please. No, it could be my fault. One thing is helpful is that not all contracts are built equally. And so sometimes we'll come and let folks know, oh, by the way, we're going to engage in a contract, and it's a 2-year contract potentially, because we have sort of a menu of options depending on what contract. But we have, for instance, 2 contracts, LRS and actually Empower, where we have to file what's called the contract waiver plan with the Agency of Administration, and thereby usually it's recognizing that these are difficult to obtain services, and the transition of contractors is very disruptive to both participants and the sort of state functions. And so there's a longer opportunity there to do, we'll still do 5-year contracts, but now instead of doing 1 5-year contract like it's normally approved, you actually have the opportunity upon sort of mutual agreement and extension to actually get out to 15. Often we'd recommend still going out to RFP or advising boards to look at their options generally. And we've done that recently, but just letting folks know that not all contracts are built equally. Could you go one more, please, Bill?
And both the waiver plan and that bulletin 3.5 that Justin was talking about, these are the tools that are there to help the board fulfill its fiduciary duty, because they force us, in order to even talk to you guys and present it, to have gone through all of these competitive aspects to make sure that there's a whole host of legal provisions that Justin is often banging his head against the wall with other attorneys from the vendor to try and align on expectations with regard to data security and topics like that. So it's part of what I think is really valuable in this presentation is just to kind of having a refresh that, there are all these building blocks that get that are built before anything comes your way. Yeah. And incredibly stringent in the sense of any, as any deviation is incredibly hard, requires multiple agencies, and is like, nothing is done willy-nilly. And so this is in the packet, just to give an idea of sort of our current contracts that this board in some way either gets the services of or has approved, and really just trying to get folks to see on that zoomed out level. You'll see the original, which means we're in the first term of the contract, really shows how many contracts we're fairly early on with. And a couple of those are the contract waiver plans, but showing that there's a lot of pieces to this puzzle, and also showing that we have, and on the next slide, you'll see that there's sort of an upcoming next. And so we're going to keep building this into the rotation, letting folks understand. So we understand that it can be, I don't know, frustrating, but surprising when it's like, oh, a contract's coming, we're asking for approval or input on something. And I think here we're trying to, give some spoilers to the end of the story, letting folks understand how this fits into our 30,000 foot, into our general contracting scheme, letting you folks know when, we may need an RFP, for instance. We may go look, at some of these contracts that are a ways out, and letting you folks know. So when you hear about something, it's not just we had no idea that, Thomson Reuters, that we were going to be hearing about that. And so I think this is sort of the framework for what we'll be providing on a regular basis, just to help provide, that guide, so you don't get necessarily surprised, and there's understanding of how these pieces all go together. Because the contracting is never going to stop, especially because you have overlapping terms with, every, I think I have 6 contracts outside of this that have to get done this week, so there's all these contracts that all start at different times, that are going for different times with all these different iterations. And so this is hopefully just going to be a standard part of your review, so you understand exactly where we are, in our tail. So happy to answer any questions now or any other time. We just wanted to sort of let folks see this, and this is going to be probably the exact way it'll be presented, I think, at this, normal interval.
I really appreciate Justin putting this together, and I think I can safely say that this is one of many ways he's improving on the prior general counsel's work, in keeping everything organized.
It's really well organized.
You think, right? I'm good. He's pointing. He's pointing. Not me.
But truly, Justin is a one-man legal shop, and this is just the VMERS contracts, and we have the whole rest of the office too. So I really, echo what Tim said. I mean, the organization and the level of attention to detail, particularly, something that keeps me up at night is information security. And that's been a real point of growing emphasis. And, we have a whole agency of digital services that have a whole section devoted to that. And Justin works with them very closely on these topics. So, it's really great work and necessary.
Thank you. Any other business from board members or Tim?
No, I wanted to thank everyone for coming in and for taking all the time today. I know there was a lot of information coming at folks, so feel free, if anything is, you want to talk about anything further, to reach out individually. If folks want, we can make time on a future board meeting for any one of these to kind of have more of a board level discussion and have someone zoom back in. So happy to take guidance on this, but really wanted to thank everyone for making the record and sticking with it.
Thanks, Jim. Thanks for putting this together.
Great. I think we're meeting next June 17th. Be back to our own little rooms, and Bill will be. But I too appreciate the opportunity to see everyone. I think my first meeting in front of this board was maybe a couple of months before COVID, and then my second. Appreciate it. With that, I'll entertain a motion to adjourn.
I just wanted to add, I apologize for not being there in person. I had all intentions to, but just work got in the way, and I apologize for that.
Good.
Good to see you. You got a nice big
Yeah.
square. It's almost like you're at the head of our table.
Thanks.
Okay, so motion is seconded to adjourn. All in favor, please say aye.
Aye.
Thanks, folks.
Thank you.
See you tomorrow. Please take food and drinks. That's a snack. It's a big success. Oh, yeah.
Because
And then we'll pursue it more. Yeah.
Yeah.
Oh, yeah, because instead of a chat, will you rewrite this for me in better language?
Morgan, you want to go to Senate Finance?
Yes. Yep. Jeff, good to see you.
Morgan, nice to meet you in person.
Nice to meet you as
Very
well.
interesting.
Good. Not all this long.
Travel walking.
It's so.
Regular TRP meeting like today.
You know, I'm headed to a school board meeting now, trying to remember what I was supposed to.
I was just gonna ask you if you wanted to go to Senate Finance with me.
Yeah.
As fun as that sounds, you're skipping out on that. It's right there.
Testifying and